Okay, so good morning, everyone. Let's have a look at the FOMC. We'll do a bit of a preview. Recording this on the morning of Wednesday, June the 18th, 2025. Okay, so let's just have a little bit of context and see what's going on. So as we all know, the Fed has a twin mandate to keep price stability and maximum employment. Now, if we look here just at the inflation gauge, which is their preferred measure, which is the core PCE, personal consumption expenditure, we can see that it doesn't look too bad. It's about sort of 2.5 or so. But what we can see is that also going back over the last few months, it's 2.7, 2.9, 2.9. Now, if we go back, let's say 3 years or even 5 years, you can put it in perspective, and we can see that although it's come down significantly since the bad days of peak inflation in the middle of 2022, we're still actually not really this sort of we seem to have plateaued basically, and it's not really coming down where the Fed needs it, down to the 2% target, which is not to say it cannot get there, and it's not slowly going towards there. And so the problem here for the Fed in terms of their inflation target is that although they have been making progress towards inflation, it does seem to have plateaued. And there are now sort of the issues of potentially the Trump tariffs. And so let's just have a quick look at that. And I just want to show you something here. If we look here, this is something I saw from Bob Elliott, which is kind of quite good. This is actually from Goldman Sachs here. You see, the problem here is that if we didn't have any tariffs, according to the Goldman Sachs economists, in the core PC inflation would actually sort of trend down over the next few months, and basically within, let's say, 6 months would be here at the 2% target. The problem is that if we get sort of, a high level of tariffs, or even the current level of tariffs from, let's say from a couple of days ago, or even, 10% excluding, Mexico and Canada, the problem is, as you can see here, that in all of those different tariff scenarios, and one of those is probable, we might be somewhere, let's say, around about sort of, let's say, the green level or so. The problem here, as you can see, is that it's going to take a long time to get down to 2%. According to the Goldman Sachs economists, it might even take sort of 12 to 18 months. So the problem here for the Fed is that even if they think that they are tempted to sort of start a cutting cycle or restart the cutting cycle, they don't really know what's going on in tariffs. And the best indications, including their internal modeling, is saying that even with sort of a relatively modest level of tariffs, there is some probability of inflation remaining, let's just say, sticky at best, and possibly even going up 1% or so at worst, even up to 3.5 or 4, something like that. The second issue as well, of course, is that we've had a bit of a spike in oil prices. Now, the Fed's probably not going to look at that, but the reality is that the readings over the next 2 or 3 months, if we continue to have relatively elevated energy prices, is that that's not going to sort of help any of these sort of readings. So the point here is that for the Fed comfortably to sort of start cutting interest rates, it's going to require probably a lot more clarity on the tariffs. And secondly, it's probably going to require not 1 or 2 months, but maybe 3, 4, 5 months of inflation, core PCE, which seems to be coming down. And also probably, as I say, some sort of indication that the pass-through in prices from tariffs has either sort of passed and has been incorporated, or maybe it's not happening. Now, some people will point to last month's sort of CPI numbers from actually about a week ago and say, hey, that was a lot lower than expected, as was the PPI. Now, that is exactly true, but there's some evidence that there was a lot of spending sort of front-running the tariffs back in sort of April, and basically last month, and we saw this yesterday in the retail sales. So yesterday, for example, in retail sales, car sales had fallen off a cliff. And so it does seem that there was quite a lot of front-running sort of maybe in that sort of late April, early May period. And subsequent to that, people have pulled back a little bit. Now, you could read that in two ways and say, okay, that means that the tariffs is not really a problem. We're not going to get inflation. Or you could simply read that another way and say that, the tariffs have not yet, that was all sort of sales on old inventory. And now that as new inventory moves into sort of shops and warehouses, that new inventory will reflect the higher prices based on tariffs. And again, we don't have any certainty on tariffs, and we don't have certainty on oil prices. So all that to say that there's a lot of uncertainty for the Fed. Now, the other way of looking at the other issue, so that's basically what's going in inflation. It's just going to make it very hard for the Fed to cut, even if they quote unquote wanted to. The other thing which is kind of interesting is then to look at sort of the labor market, and you say, well, okay, so the Fed has the Fed has a second mandate, which is to maintain full employment. And you can say that at the moment. You can look at this. This is just the unemployment rate here, which is pretty basic. You can say, well, it's going up. It was at 4.1. It's now 4.2. Actually, the unrounded was 4.24. So there is an argument to be made that the employment market is weakening, and I think we can definitely see that in things like initial jobless claims and the number of new jobs being created with non-farm payrolls every week. But if we actually go back, let's go back to let's say three years. You can see here that it's actually sort of more or less been around about this level. And if we go back actually for 5 years, you can see that although it does seem to be potentially ticking up on any kind of historical basis, the unemployment rate is actually still pretty low. Around about 4% is solid. Above 4.5% to 5%, 6% is a problem. But look, if you actually go back all the way to 2022, we are at these sort of levels, late threes, even up to four. So my point is that the Fed could probably live with that going up another few tenths, maybe 4.3, 4.4, 4.5, 4.6. These are still not sort of historically horrible levels. The second thing to think about employment as well is that we know that one of the main things of the new sort of relatively new Trump administration has been that the borders, there's a lot less immigration coming into the US. And I've been looking at a lot of numbers of that. And the point here is that all of those sort of hundreds of thousands of sort of immigrants, legal and undocumented, they're no longer coming into the US. And that means that there's less of a pool for workers. And basically what that means is that actually the replacement rate per month to replace jobs necessary to create to accommodate those new workers. It used to be at 150, 175,000. It's now back down, according to economists, to about maybe 100,000. So the point is that the US economy, because there are not sort of hundreds of thousands of new people crossing the borders sort of every quarter, basically less jobs need to be created to maintain a flat unemployment rate. So the thing is that even though maybe there are less jobs being created, the unemployment rate will not necessarily skyrocket anytime soon to 5 or 6%. What's the conclusion? The conclusion is that the Fed doesn't have to worry too much at this point about the unemployment rate, and they probably will be looking for it. They will probably need for it to visibly deteriorate in a very serious way, very aggressively, for the Fed to really take notice of that in terms of formulating their policy. Okay, so grab some water. Let's just look and see. So obviously, what we get today, we get the interest rate. Nobody's expecting the Fed to cut. Of course, they're not going to hike either. But what we do get, which we didn't get last time, we get the updated a summary of economic projections. The last one here was March. We didn't get one last time. So what's going to be quite interesting, first of all, is the famous sort of dot plots. Now, what we can see is that from the last time, basically they were unchanged. And essentially, to keep this sort of simple, what the Fed is telling us is that the current Fed funds rate is between 4.25 and 4.5, the band where they like the Fed funds rate to be. The effective Fed funds rate at the moment is 4.33, and it's been that way for the last couple of months. So basically, by projecting 3.9 at the end of 2025, the Fed essentially back in March was telling us that they were expected to cut twice this year. So the big debate today is will they maintain it at 3.9, which would indicate the Fed, in theory, the median dot is going to be for 2 cuts, or will they actually be tempted to take this down 25 basis points? So this will go down to 3.6 or 3.7, something like that, and basically take that down. The same thing here is for 2026. That is expected, that is signaling another 3 cuts in 2026. So the key thing to look at today at 2 o'clock when we get this new release is, does this number stay at 3.9 and 3.4, or does this number come down? If this number comes down, of course, that is hawkish, and that is saying that the median Federal Open Market Committee member is penciling in only 1 cut this year, which of course would be a hawkish repricing of 25 basis points. Now, we all know the dot plot is simply an estimate. If the data comes in particularly hot or particularly soft, the Fed will do what they want to do. But the point is that symbolically, and in terms of the market, this is going to count a lot. So this is very, very important. And if we actually just look and have a look here and just see sort of what's been priced in currently by the markets. So we go here. Now this is on the futures, which is like the Fed funds futures. So there's different ways of looking at this. You have the overnight interest rate swaps. You also can just look at options, which are actually a little bit more hawkish. And I was looking at something this morning. If you actually look at the options so the options market, it's actually a little bit more hawkish, and the median is only for a 34 basis point cuts by the end of the year, and in fact the mode is for no cuts. So a lot more hawkish in the options market. But if we look at the actual pricing of the Fed funds futures, we can see today obviously nothing priced in. And as I've been talking about, in these videos over the last week or two, if we look at, let's say, by the end of the year, so December 2025, at this point the Fed funds futures market is pricing in 1.8 cuts, which equates to about 46 basis points. So at this point, the dot plot is broadly in line with the Fed funds futures. So the dot plot is saying two cuts, the Fed funds futures is saying two cuts. But then if we look at towards the end of 26, which would be here, it's looking at four cuts. And according to the Fed, it's probably more of like 2 plus 3, which would be 5. So in this case, the further we go out to 2026, the market is, a little bit more hawkishly priced than the Fed. Now, in terms of what's been driving that, it's pretty simple here. We've got a little bit of geopolitics, but mainly it's just sort of the data. As we're getting, for example, we had non-farm payrolls, which was stronger than expected. So we went from 55 basis points of cuts priced in. This is December pricing in terms of the number of basis points. So this was the non-farm payrolls. And then, of course, we had the CPI and we had the PPI. And then subsequent to that, we've had sort of Fed speak. And we've also had the spike in energy prices, in oil prices, nat gas prices, and gasoline prices, which essentially has sort of put a bit of a fear into the bond market, essentially saying that that could at the margin force inflation up a little bit, which again would make it more difficult for the Fed to cut. But the bottom line here is that the market, as I've been saying the last couple of weeks, is hovering around about 50 basis points, which you can see is here, which is two cuts. Now, if the dot plot were to be revised just to one cut, obviously there's the potential here. This little chart here we'll see a very aggressive spike going upwards to probably, something around about 30 or 25 or something like that. This would definitely spike up and be very aggressively repriced. And just another way of looking at that, we can have a quick look here. I just want to look at, what do we got here? Yeah. Actually, I'll look at that later. I just want to look at the dots here. So we can look at the dot plot here. I'm just going to bring this up quickly. And we can see here that by the end of 2025, you can see here, this is where all the different members are in the last summary of economic projections. And what's going to be interesting is that we could have an outlier. There could be, a couple of more doves. And so someone like Waller, who potentially wants to get the job to replace Powell next year, Waller could actually argue maybe for 3 cuts this year. So we could see someone like Waller sort of down here, maybe 1 dot. But I think they're going to coalesce around the middle, and we could even see 1 or 2 doves. It's rumored that Powell himself is a bit more on the dovish signal with 2, but I think this is going to sort of tighten up a little bit, this distribution of dots. But what you can see here is that this is the dots here. You see the green one here is the median and the Fed funds futures, the latest value, which is the white. So you can see here that the Fed funds futures and the dot projection is, as I said, more or less exactly at the same point. Where it starts to sort of differentiate a little bit, as you can see, as we get towards the pricing for the end of 2026, and you can see here that where the FOMC members are, they're a little bit sort of up here compared to where the market is here. So you can see here that the Fed funds futures market is a little bit further down. So just a little bit of a differential there. I'm not going to worry too much about the longer term. Okay, so that's interesting. So if we get back to the sort of the summary of economic projections, where there's going to be a lot of attention is going to be on these changes in the economy. Okay. So first of all, we need to be looking at the core PCE inflation. Now, as you can see that already back from between December and March, that was revised upwards from 2.5 to 2.8. This is going to be pretty critical here. Will the Fed revise this upwards, maybe to 3%, 3.1, I don't know, 3.4? There was some talk that even before the trade deal with China, that they may even have put this up to 3.5, 3.6, or even up to 4%. Now, subsequent, to to that, in the last few weeks, basically, there has been a little less aggressive rhetoric from the White House and from Trump himself. There was this sort of a semi-deal between the US and China. Still no deal with Europe. Still no final deal with China, and no deal with Japan. So there's a lot of uncertainty, but it seems quite possible that the Fed will revise upwards the core inflation numbers. Also, what's going to be interesting, that was unchanged last year. Let's have a see what they say in 2026. Will they actually sort of signal the fact that they think that inflation will be trending upwards, or at least remain fairly sticky, not only in 2025, but also in 2026. So we need to see if these numbers here change a lot, and by how much. The market is expecting those to go up a bit, maybe 1 or 2 or 3 tenths. What would shock the market would be, 3, 4, 5 tenths. The other interesting thing as well is the unemployment rate. As we said, at the moment, it's about 4.24, I think, from memory. So the Fed did revise that upwards for this year. They kept it on hold for 2026. Again, are we going to see this significantly revised upwards? 4.5, 4.7, something like that. That's going to be telling us whether the Fed thinks that there's going to be an economic slowdown. And of course, another way of signaling that is the change to the real GDP, gross domestic product. Now, the Fed, as you can see, they actually revised it downwards, so weaker at the last meeting, and they also did that the same for 2026. So the key thing here is that will the Fed be going for some kind of stagflationary sort of projection by which they say that the Fed funds rate is not going to be cut, that inflation is going to be sort of further revised upwards, and actually unemployment rate revised upwards, and actually the GDP revised downwards. So we need to be looking at these 4 numbers, maybe not so much the headline number here, don't have to worry about that one, but definitely the core inflation, actually these 5 numbers. These are the key numbers which the market wants to be looking at. The other thing is, well, which we might check out is the statement. Will that change? I just pulled up something here from the Bloomberg terminal. Basically, this is what the chief economist of Bloomberg, how she thinks, Anna Wong, the statement might change just a little bit, not massively, but we have to keep in mind what some of the changes could be in terms of the outcome. So we can say that here's what they think that some of the changes could be. So recent indicators suggest that economic activity has continued at a solid pace. So still the Fed saying that, the economy is still in good shape. And it's true that if you look at the economic data, there is some evidence that there's certain cracks in maybe the labor market and whatnot. But essentially, the US economy still seems in pretty good shape. What about the labor market? They might say that the job gains have slowed, so they might indicate that they're looking at the job gains have slowed a little bit, and the unemployment rate has remained low. But they're still basically saying that the unemployment rate is remaining low, so it's not a problem. So therefore, they might say that yes, there has been a small slowdown with the unemployment, but the rate itself actually remains pretty low. Now, in terms of the key thing on inflation, they could say inflation has made further progress towards the committee's 2% objective, but remains somewhat elevated. That's definitely going to be quite interesting, because the problem is it's still a bit sticky, essentially. So that's and then, in terms about the economic outlook, they can say that the uncertainty remains elevated. So they're basically saying we need another 2, 3, 4 months to cut. So it seems to me that rather than cutting today or in July, a minimum earliest could be September, but a lot of market participants are saying, maybe not even until December, but potentially in December, they may want to do a 50 basis points cuts. Who knows? Maybe that's their thinking. Get 2 or 3, 4 months more of data, and then they can actually, once they're certain or have more confidence that the economy maybe is weakening and that the tariff situation is better understood, they could actually cut 50 basis points in December and therefore still obey, so to speak, the dot plot. The other interesting thing to think about in terms of the statement is also going to be the reinvestment, and we'll see what happens in the press conference about that. So Just in terms of the press conference, I think obviously, let's say, for example, in the summary of economic projections, they are a little bit more stagflationary. Let's see what Powell has to say. And in terms of the dot plot, the way it could work is that Powell, let's say, for example, they reduce the dots to only one cut. The market would take that in a very hawkish way. But on the other hand, in the press conference, Powell could be sort of talk that back and say, oh, I don't really care about the dot plot. We're data dependent, et cetera, et cetera. On the other hand, if they keep two cuts in the dot plot, Powell, on the other hand, could be slightly more sort of conservative and a little more hawkish in the press conference and say that, it says two cuts, but that's going to be data dependent. So the thing is that Powell can play good cop or bad cop and sort of counterbalance whatever the message is in terms of the dots. Now, in terms, and so that's going to be interesting. The second thing, apart from a lot of things to think about, is also going to be reinvestment. And so there's some idea at the moment the Fed is reinvesting in terms of their bonds quite substantially towards the long end of the curve. And so it will be interesting to see if we get any more information that they're going to keep on reinvesting, but maybe push the reinvestments a little bit to the front end of the curve. If that's the case, that should support the front end of the curve, could lead to a little bit of sort of steepening in the curve. So definitely that whole question of reinvestment is going to be interesting. Now, the other thing which also is quite interesting as well is the political aspect. And we know that Trump is really, really pushing for a full basis point of cut. He's called Powell too late Powell. He's called him a numbskull, an idiot. Doesn't understand. Everyone else is cutting, but but not the Fed. So the point is, there is a lot of political pressure on Powell to cut. I don't know. I don't want to get into psychology, but it seems to me that if I were Powell, that's probably a very good reason to be very certain, to resist that political pressure, to actually sort of really sort of communicate to the global markets that the Fed remains highly, highly independent. And that actually, I think, makes the bar higher, paradoxically, for the Fed to cut. So I think Trump may have made an error there of judgment. But what is interesting is that Powell's term comes to an end next May, and Trump, after a few sort of comments here and there, has basically come to sort of say, no, he's not going to fire Powell. But the market is assuming that the next Fed chair is going to be extremely dovish and almost instantaneously will cut rates, possibly very aggressively. And so the implication there is next June of 2026. And so there's been a big institutional trade happening over the last few weeks, which is essentially you can see here, and this is in the SOFR's contract. This is open interest from a couple of days ago, just giving you a sense of this. If you look at the open interest, which has changed over the last week or so, look at all the buying in the June contract, and look at the selling in and look at the selling in the other contracts here. So basically, what's been happening? There's been a crazy trade of, and I can show you this of. Traders essentially shorting sort of contracts before Powell leaves and going long contracts when Powell comes in Powell's successor. And you can see just how this has all moved a little bit. So what I've done here, I've normalized this. This is the SOFR pricing for all the different contracts here. So you've got September 05. And I've normalized this until when Trump came to power, so basically the 1st of February approximately. And what we can see here is that the more we've gone on in Trump's sort of reign, if I could call it that, or term, we can see there's been a big differential here. So you can see here the white one down here, the pricing has gone down in terms of differential -10. And that's for September of 2025. So then as we go out further out the curve, you can see here December 25, the blue, just follow the numbers here. Then you can see March 26. You can see June 26. September 26 and then December 26. So you can see quite clearly here that basically this is the closest one. So this is one expiring in, actually September 25, going all the way out to December 26. And you can see here that the market is much more hawkish in the short term and is essentially has increasingly priced out more and more cuts back weighted into 2026. So the market certainly is not expecting any kind of aggressive Fed action until and unless we get a significant potential deterioration in the in the real economy. And just getting back to that sort of Trump Powell trade, you see here I've got here March 2026 SOFRs, and then I've got June 2026. So this is the last one when Powell is still at the head of the Fed. And then the June contract is when the new person comes in. And what we can see here is that if you look at the pricing here above, you can see that the orange line, which represents the June 26 here, you can see that that pricing has remained much more elevated by comparison with the March contract. And you can see that differential here has blown out now to about 22 basis points. And essentially, this is traders sort of assuming that when the new person comes in to replace Powell, almost at that very first meeting, they're going to be very, very dovish or perhaps even sort of a cut. So that's an interesting one to keep an eye on. Okay, so just to finish off here, if we look at some of the market reactions, as I say, just to sort of go back here, the market is expecting absolutely nothing today. It's all going to be about the guidance and the dot plot, so we have to look at that pretty clearly. If we, the market is not expecting a huge amount of changes. So if we just getting onto some charts here. So if we look at something like, let's just look at the bonds. Let's go and look at the bond yields. So something like the 2-year, I don't know that it's going to change particularly sort of over the long term, but for sure today we could get some volatility. If that dot moves to only 1, for sure the front end of the curve, obviously the SOFRs, but the 2-year yield here will definitely go up. But I don't know that it's going to get too much higher than these levels here, about 408, 410, something like that, just because that would signal only 1 cut this year, and that's and actually over the next kind of 2 years. So I think the front end of the curve could move for sure. So that's something to look out for. On the other hand, if the dots remain saying 2 cuts, again, I don't know it's going to have too much volatility on the downside. Could the yields go down? I guess there could be a bit of a relief rally. The market is happy that the Fed is still penciling in two cuts. That's a possibility. But I think the possibility of a hawkish reaction to the upside is much more. If we do get that hawkish only 1 cut, I think that's going to be a negative, all things considered, for the stock market. If we look here at the ES, we can see that it's getting towards sort of highs here. And I think, for sure that could come down, but maybe not a huge amount, because that's also indicating that the Fed still is planning on cutting this year sometime, is still going to cut in 2026. And possibly even more importantly is that the Fed is still serious about combating inflation, which ultimately is going to be sort of good for the economy. And it's the same thing here for the bond market, for the curve. If we look at something like the 2s30s curve, which I'll bring up if I can find that here, the 2s30s, you can see here that that's been sort of pretty sideways, a slight flattening just at the moment. If we were to get that only sort of 1 cut penciled in, that, of course, could push up the yields at the front end. So we could get a bit of flattening here, just because, ultimately the long end of the bond market quite likes a proactive Fed, which is actively fighting inflation. So even though those yields might go up on the back end of the curve, the 10 and the 30, probably not as aggressively as the front end. So we could get sort of some bear sort of flattening at that point. Also, what's going to be important is just what the market thinks about what the Fed says about the future economy. So the summary of economic projections in terms of GDP and inflation, that's going to affect that. Just finally, guys, just to finish off here, we do have just in terms of the dollar. Now, the dollar has sold off a lot, as we all know, at a very key junction here. You see this big sort of downtrend here. I could also throw in some sort of moving averages and whatnot. Actually, let's just throw on some moving averages. So you can see here the dollar here coming up towards this 20-day exponential moving average, and this very strong resistance here. Let's see if it pops through just at the moment. It's been rejected. But again, this is going to depend a little bit on the Fed. If the Fed is dovish today, maintains the 2 dots, maybe even talks about, let's say, for example, Powell in the press conference says that, they have noticed a weakening labor market. They're concerned about the economy. They think that tariffs maybe are not as bad as feared, that the tariff effects will be a one-off price increase. et cetera, et cetera. Anything dovish, for sure, the US dollar, the dollar index here can push down at a minimum to test these lows at 97 and three quarters, or even push down there. On the other hand, the opposite, anything sort of hawkish, they're worried about inflation, the tariffs effects are not well known, the economy is still quite strong, the unemployment rate's not a problem. They will only cut when and if they feel the necessity to do so. I think the dollar index for sure could pop and break this level, and it might actually start breaking some stops and it could test up towards the 100 level, the 50-day EMA. And of course, that's going to be reflected on all of the cross currencies as well. Okay, I'm going to leave it there, guys. Obviously, we also have to keep, there's no military action overnight. As had been potentially sort of feared or anticipated. So not a huge amount of sort of volatility in the markets, especially in the oil market and the energy market. If we just have a look at that, we can see here that oil, look at the front contract here, did spike a little bit yesterday, and just sort of trading in a range, just sort of waiting to see. It does seem as though there's been a lot of military assets being moved from the US into the base in the South Indian sort of Indian Ocean, the Diego Garcia Air Base, other bases in the Middle East. So it does seem as though some sort of military action is potentially on its way. Whether it's going to be that sort of famous bunker busting bomb to destroy the Iranian sort of nuclear sort of enrichment facility underneath the mountain, we'll see. So oil, I think, is just waiting for that. This definitely could spike higher. We also have to see if such a thing were to happen, if the Iranians have any sort of sense at all of possibly blocking the Gulf the Straits of Hormuz. Oil, of course, could spike much higher. And if oil were to spike much higher, of course, that's going to have an effect on yields, which no doubt would sort of rise. And again, that makes there's inflation fears, which again makes it complicated for the Fed. Okay, but I think I'll leave it there. I've already spoken too much. So I hope that was useful. Have a great day, and we will keep all of this rolling. Thank you.